Hi, everyone. Welcome to the COVID and BDCs 2020 BDC Roundtable session. My name is Stephanie Hildebrand. I'm a partner with Evershed Sutherland, and I am joined by my partner, Kristen Burns, on this panel, as well as other industry professionals and clients of ours that work in the BDC industry. I'll start by introducing our panelists, and then my colleague Kristen Burns will give a little background about what we're going to be talking about today. First, we're joined by Dean D'Angelo. He is the founding partner of Stellus Capital Management, as well as a board member on the BDC, Stellus Capital Investment Corporation. We're also joined by Matt Giordano. He is the deputy lead partner of KPMG's Public Investment Management practice and the lead engagement partner and technical resource for a number of their BDC clients. Matt is also the former chief accountant of the SEC's Division of Investment Management. And then finally, we're joined by Cindy Maas. Cindy is a managing director and global head of portfolio valuation and fund advisory at Houlihan Lokey. Cindy works primarily with private equity funds, hedge funds, and BDCs in valuing their illiquid securities and establishing best practice in class valuation policies and procedures. Cindy is a board member of the Financial Instruments Board of International Valuation Standards Council. And prior to joining Houlihan, Cindy was a partner at EY. So with that, I'll turn it over to my colleague, Kristen, to let everyone know a little bit about what we're going to be talking about today.
Thanks, Stephanie. Since the beginning of the COVID-19 pandemic, we have seen the BDC industry adapt to a very challenging environment. Almost all BDCs have moved their workforce to be fully remote and have seen their portfolio companies directly affected by the economic shutdown. As a result, BDCs have had to increase their portfolio monitoring while working remote, and in many cases bolster their workout teams. In addition, capital raising has been more challenging. While there have been some successful debt and equity issuances, at least 26 BDCs have had to reduce or suspend their dividends in order to preserve liquidity. In addition, the availability of credit facilities is less clear in this environment. So today we are going to discuss some of these issues, beginning with valuation and accounting. Our first question for our panelists is, what changes have you seen comparing first quarter valuation processes to the second quarter valuation process? And do you see any further changes for the third quarter? Cindy, do you want to kick this one off?
Sure. Valuation challenges induced by COVID since March are unprecedented, as the issues are dynamic and evolving from quarter to quarter, which require a deeper review of a variety of factors, such as 1, availability of updated financial information, 2, credit profile of the borrower prior to COVID, and the expected impact of COVID on the borrower's business, 3, level of sponsor and lender support, 4, near-term liquidity needs, and 5th, likelihood of a borrower experiencing technical and/or payment default under its various credit agreements. The financial market has been volatile with the start of COVID at the beginning of the year. The public credit market dislocation in March resulted in substantial widening of broadly syndicated loan indexes, with first lien widened by 400 basis points and second lien by 800 bips. The spread widening was partly due to credit deterioration and increase in risk premium, but more to do with short-term liquidity issues as asset managers try to meet margin calls. For example, for March 31 valuation, given it was difficult to get a sense of what the new normal would be, and unfortunately, financial and cash flow forecasts at that time were not reflective of COVID impacts, discount rates became the key valuation driver. However, determining the appropriate spread adjustment to the discount rate was challenging, as we did not want to simply benchmark to the broadly syndicated loan indexes, which could result in unnecessary write-down of certain healthy loans. Under the fair value concept, the principal market for private credit is not the broadly syndicated loan market. Valuation and risk go hand in hand, so private credit managers risk score their underlying borrowers and categorize them into high, medium, and low risk buckets. Generally, high-risk buckets included borrowers in sectors clearly impacted by COVID and geopolitical tensions induced demand and supply shocks, such as energy. The medium and low-risk buckets typically include issuers that are not expected to default under their credit agreements. In the second quarter, we observed a significant tightening in the spreads of the broadly syndicated loan indexes, with the public market dislocation in March was short-lived. Also, for the June 30th valuation, there was more information available. For most companies, there were at least some months of historical financials that were COVID impacted, i.e. the March and April financials. The outlook for certain companies, while still uncertain, become clear for Q2 since portfolio company management and sponsors had more time to access the impact and stabilize companies by addressing any short-term liquidity needs. Additionally, structural features such as the existence and level of LIBOR floors became a lot more valuable for private credit lenders in the second quarter as the 3-month forward LIBOR curve declined materially between Q1 and Q2. Further, the focus in Q2 shifted to clearly understanding the liquidity of middle market issuers. As mentioned before, in Q1, with the financials and cash flow forecast did not reflect the COVID impact, discount rates was a key driver to capture the additional economic risk associated with the pandemic. By June 30th, some private debt issuers have started to reflect COVID impact in financial results and in the 2020 projections. So the challenge for Q2 was to avoid double counting of the risk in the valuation process. In other words, if the expected cash flows are risk adjusted to a certain degree, there should be more consideration as to the amount of spread adjustment made to the discount rate. So moving to the third quarter, as we're approaching September 30th valuation, we expect to have even more COVID impact trailing financials, as most portfolio companies will be reporting results at least through June. This will help better separate the companies that are managing this environment well from those that are not. We expect some companies will need additional liquidity to the extent short-term liquidity bridges put in place for Q1 and Q2 start to run out. Similar to what we are seeing in the public equity market benchmarks, some deals are once again being done at extremely competitive pre-COVID pricing levels, while for some in the more affected industries, defaults are expected to continue to rise throughout the year into 2021, resulting in further negative valuation implications. Back to you, Kristen.
Matt, do you want to weigh in on this as well?
Yeah, sure. And I'll talk about it from more of the accounting side. Some things to keep in mind when it comes to valuation from an accounting side. And, I said the same thing when I was on the regulatory side as well, is that make sure when you're thinking about valuation, that exit price is almost your true north, right? So a lot of times we see folks get in trouble when they start to say things like, although there's certain market data out there, we wouldn't sell it at that price. Right? Or, the valuations that we're seeing out there right now in the market are based on a distressed sale without having the real support to understand why it's a distressed sale. Or even worse, we hear sometimes, well, the entire market is dislocated, right? And both the SEC and the FASB have come out and said, you can't say that the entire market is dislocated or the entire market is under so much distress that the marks that we're seeing right now aren't indicative of the fair value. It's really company specific. So with all that being said, I would say, there are certain companies, as we've heard Cindy say, that are experiencing difficulties, and there are other companies that are thriving, right, that are probably doing better under this environment. I would say that there's less of those, of course, but, we've seen different changes in the valuations, and I would say focus on the company's metrics as well as the big picture. But a lot of these are very, very specific to the company. And a couple other things to point out is whenever there's a recession, right after the recession, we see a number of enforcement cases around valuation. And it's not just around valuation, it's around the management fees that are associated with potential increased valuations. So I would say, really, really focus on valuation at this point. If you decide that you're using a model that you no longer think is appropriate to use. Certainly make sure you're documenting why you're switching from one model to another, and that you're just not throwing this model out, but there's reasoning behind it. We've seen cases in the past around this issue, and we certainly see a number of OC deficiencies in that area. So I would make sure that you understand the difference between the old model and the new, and document the reason for change. And the last thing that I'd like to point out around valuation is we're certainly seeing a number of boards that are asking for more third-party valuations, and this is coming on more recently. And also, when they're getting these third-party valuations, really making sure that they're breaking down the assets, or trying to bifurcate the assets by risk, number one, and then industry or geographical location. So if you're not doing 100% and you just want coverage, that you truly have coverage across your portfolio. So those are the big items that we're seeing right now.
Thanks, Matt. Dean, do you want to weigh in from the management side?
Yeah, I know. Thanks for hosting this also. Yeah, it's an interesting topic in these times. I think, when you think about it from the perspective of someone managing the portfolio in the BDC universe, the vast majority are not traded liquid loans. So you always have the dynamic of what's happening in the larger market and the liquid market, which we use as a benchmark, the tradable loan market. And then you always are balancing that with the fundamentals of the underlying company, and sometimes they diverge. And so Q1, you saw this just massive divergence in many cases where you had companies that were still performing pretty well. The liquid markets traded off and gapped tremendously. And so going into this valuation process, everyone is trying to determine what the intrinsic value is, what someone would pay for it. It was very difficult because you didn't have good value points on how these companies really will perform over the next few months. The world had changed so dramatically. And in the face of just the gapping out of spreads, I think everybody took a very conservative view. Very few people were able to say, hey, this company is going to hold up really well or poorly. So you saw from a manager's perspective, really just looking at each company and understanding where the markets have had and determining whether you wanted to add more risk onto it. And then, so that was really the tale of Q1 was markets gapped out tremendously, and you don't even know what the prospects of your underlying portfolio companies were. Q2 changed dramatically in that I think there was a very large pickup in the markets, meaning spreads came in pretty materially. And as I think a couple of other people had mentioned, you started really seeing winners and losers. You started seeing that companies are going to be able to operate relatively normally, or they're getting hurt, or many that are getting benefited. So I think in Q2, you got a pickup from valuations, but you were also able to be significantly more informed and objective when you were adding, well, how does this company perform, and how do you mix that with what the market's saying, sort of in a little bit of a different market, a traded market. So that, I think you entered back into where the management really had some value to add in terms of looking at the index, but also looking at the companies for really how well it's performing. Q3, I think if things continue the way they are, it's going to be back to a relatively normal world pre-COVID, where you have good data on your companies. You know which ones are doing well. You know which ones are doing poorly. You see where their markets are. And, I think you've just moved past a lot of the volatility, assuming things, really don't get difficult again.
Thank you. So then moving on to our second question, in a COVID world, what should BDCs consider when deciding whether to place an investment on non-accrual status? Matt, would you mind starting this one?
Yeah, sure. It's an interesting question because I think for a long time, a number of folks have not really taken a hard look at their non-accrual policies. And we saw over the past 6 months, a number of BDCs or boards ask about non-accrual policies and ask if those policies and procedures should be tightened up a little. The areas that we're really seeing them focus on is where you may ask, or the BDC may not put an investment or a portfolio company on non-accrual status until they've missed multiple payments. So you start getting these questions around, okay, I missed payment number one. Is it known or knowable? Should I have known, or do I have information that would lead me to believe that, well, they're not going to make the next payment either? And when you see those sort of instances, I think you start to relook at these policies. And I would certainly say if they've missed one payment and you don't think that they're going to make the other, it's time to put it on non-accrual status. But again, it's very company specific. The other area where we see folks spend a lot of time is where there are maybe partial payments, and should they recognize the full income, so it's kind of a partial default, or another instance is where you have both PIK and cash. So if you shut off, if they're not receiving the cash, the question is, do you shut off the full accrual of income because you don't think that you're going to be able to receive the PIK either? So I would say we usually tell people that it should be company specific, right? If you think that they can make the payments, then you can still accrue the PIK. I think it gets a little tricky when we start to say, okay, you're not receiving cash anymore. The fundamentals of the company don't look as good as they did before. We don't think that they're going to be able to pay. That's where you really need to start taking a hard look at whether or not an investment should be put on non-accrual status. And again, this, just like valuation, is an area where regulators will come in and start to push on. And we typically see that again after the recession.
And Dean, do you have any thoughts from the management side?
Yeah, this is really a difficult discussion and topic, as Matt had brought up. Whenever you're a manager and you're seeing a portfolio company that's an earning asset, and all of a sudden it's running into a bump in the road, and they want to go to PIK. And I think that it's incredibly important. It's a company-specific question, and I think it's not one of these decisions where optimism and hope should be part of your answer to say that I'm going to continue to accrue interest. And I think that's one of the issues, is really being objective. And remember, every time you bring something into income, it's easy when it's cash, but it's as if, you're selling a good. I mean, are you going to get paid for that product or service, right? And so I think when we look at it, there's a real difference. So for instance, if a company has a very specific event that they're dealing with, and it's a very healthy company, and it makes sense once they get past this, they're in a healthy market with a great model. That's something that probably is a fact pattern that leads you more into saying, hey, we're going to get paid. If you're having a company that's not performing well in a deteriorating industry, and you hope that it's going to turn around, that is the recipe not to accrue it into income. And, there's other things that, in our world, sponsor-backed companies, what type of support are you seeing financially, operationally, that leads you to believe the company is going to be healthy? But I think that a lot of, in our world, it's a sober, fact-based decision. And you really need to have a high level of comfort that this isn't a company that's going to be able to pay you in full with return. And when you start having doubts about that, it's very clear what your answer should be. It's often a hard decision to make.
Yeah, and one thing, just to jump in quickly, Dean, I think you nailed it when you said, recipe for disaster is when you hope a company will turn around and you start accruing, or you decide to accrue the PIK as income, right? And that's really where we start to see people get into trouble, where you kind of make these, I won't call them emotional decisions, but it's not based on the fundamentals of what we're seeing. You just keep kind of saying, well, we know management, we think that this is going to turn around, and that can lead to disasters.
Agreed.
So then, switching gears a little bit to accounting and financial reporting, particularly in light of remote work, what impact, if any, has the COVID-19 pandemic had on BDC's internal controls and financial reporting? Matt, do you want to start us off one more time?
Yeah, sure, Kristen. I would say as an industry, I think financial services has done a really great job when you compare financial services to some of the other industries. And I think from a BCP standpoint, for the most part, we were ready to go. A lot of the controls that are in place are electronic. The review processes are electronic in a lot of areas. So I would say that we haven't been hit as hard as other industries. I think the SEC is focused on controls, and you can see that through some of the COVID risk alerts that OC has recently put out. So they are focused on controls. I think they're going to continue to be focused on controls around the pandemic. If I was a CCO, I would certainly start taking a hard look at the compliance manuals and making sure that compliance manuals are up to date, ensuring that if you have certain oversight type functions, if you're in a financial reporting oversight role and there's certain functions that are being performed, that those are laid out as they currently stand under the COVID environment, which may be a little different than what we saw when everybody was in the office. So we take a hard look at those sort of things. But from a financial reporting standpoint, we really have not seen any degradation to the controls across really any of the BDCs that I work on. I haven't heard it from other partners. I think that there were some hiccups with some of the service providers very early on, some of the March queues. But I think that we did not see that those same sort of issues or hiccups, bumps in the road as of June 30th. So happy to say things look pretty good.
And Dean, is that consistent with what you're seeing?
Yeah, as an operator, I mean, I think it's working out well. Maybe we'll really understand towards the end of the year when there's a look back from our auditors of exactly how well we've handled it. But one of the things I think that's maybe not unique, but helpful for the BDC industry is that if you look at all the public companies, I think the vast majority have gone through the sort of lengthy, painful, and expensive SOX process that caused everybody to really think through their control environment about everything about their business. And at least for us, the process was all about documenting and being able to back up and support it. And, at that time, we just focused on making sure very little of it was paper-based and they could all be done electronically. And I think that's what most players in the industry did. So when you came into a situation like COVID where you're not there in the office, it really doesn't hinder the ability to keep to your compliance culture. I think the issue is longer term. The longer that you are remote, the less ability you have to reinforce some of the basic things around the control environment in an office. So that's what I worry about most is that, it's in place and it's operating. And it's probably harder to determine where there's holes when you're not there together to see them. But
Stephanie, I think you're on mute.
Apologies, I was following instructions. Thanks. What I was saying was, Dean, that's a good segue into our next topic. We've talked about valuation and some very specific accounting policies with non-accrual or just financial reporting and internal controls generally. But now just more generally managing in this down cycle. At this point, I don't think people know how long it's going to take, although Dean, from your earlier comments, you mentioned you thought Q3 would be getting back to normal. Maybe not out of the down cycle, but certainly back to normal from a valuation perspective and kind of figuring things out. With that in mind, what do you think the biggest challenge has been in this down cycle, whether it's related specifically to the economy or generally just, everybody being remote?
Yeah. I think the biggest challenge like our firm has had to deal with is, this concept of how do you keep the level of communication and the team cohesion when you're simply not in the office with each other. And, it's fine to say everything's electronic and you communicate, but trying to get into patterns that allow people to have the same interpersonal relationships and not be in the office. So, we've tried certain things, like, for instance, we now have a call Monday, Wednesday, and Friday morning with the entire investment team. We are all really using Microsoft Teams extensively. And, we're fortunate we've invested over time of a cloud-based sort of deal portfolio marketing program that everyone could look remotely. So, you have these systems that make everybody feel connected, but, you still are not there. So one of the things that we're also doing, and we're a smaller firm, we're 30 people. So how do you make sure you keep lack of a better word, esprit de corps or corporate culture around? So we've done things where we have regular happy hours. And we send people, this company we found called Cocktail Courier, and we send everyone home. We're non-alcoholic, and It gives a time for people to actually get together. We've done an offsite, an escape room. So, I mean, the biggest issue we're confronting is how do we make sure we're able to keep not only everyone efficient and working well, which think we have the systems, but just keeping people to remember they're part of a team, because you just don't know how long this is going to last. And, just one last thing also, how do you manage? Our office is theoretically open. No one is forced to go, but how do you go through that process of managing an office that's sort of open but sort of not? And so it's more of operational issues more than anything of dealing with the portfolio or the environment, the economy, excuse me.
And Matt and Cindy, have you seen, have clients come to you asking questions about how to manage in this situation and in the down cycle? Again, either the economy generally or, remotely working. I know we talked a little bit about it with compliance policies and procedures and remote working, but maybe Cindy first, any thoughts from you and then to Matt?
Yeah, that's actually a very interesting question, is because at the beginning of the pandemic, literally all our major clients, the largest asset managers, want a letter from Houlihan or email confirmation that we will be able to deliver. Given the fact that, they know that everybody is working from home. So the ability to meet deadlines was very important to our clients. And actually, what is also very interesting in terms of the current pandemic, the challenges for us is from a valuation perspective, we actually believe the availability of relevant and up-to-date information is actually our biggest challenge as a valuation provider. And there is always an information or timing lag in the reported financial statements. And even as recent as the June 30th valuation cycle. And the lenders only have March, April financials, which in a trailing 12-month time frame wasn't truly representative of what was going on in the real-time basis. And there wasn't really a whole lot of visibility and not enough KPIs in lenders' mind to implement a longer-term amendment or covenants reset all the way through the remaining life of the loan. So that, when we look at it, there's really no choice but take, a wait-and-see approach, which we see a lot of covenant holidays were only for a 1 to 2 quarter contacts. And the other challenge we have is clients always ask us the topic about adjusted EBITDA. And as we know that EBITDA plays an important role in financial maintenance covenants, and through the leverage ratios or the interest coverage ratios. The term adjusted EBITDA has been attracting a lot of attention in the last several years, right? And especially during the pandemic, and clients keep asking us about on whether COVID-related expenses, also referred to as lost revenue, can be construed as extraordinary losses or considered as a one-time non-recurring cost and be added back to EBITDA. So, from our perspective, my honest answer is I think the LTM or the 12-month trailing EBITDA is a less meaningful or even non-meaningful figure in certain situations. Instead, we always ask questions such as, what percentage of pre-COVID levels is the company currently operating in? What percentage of stores, locations, factories, or medical practices have reopened since staying-at-home orders have been lifted? Or comparing to your expectation at the onset of pandemic in Q1, how will you assess the performance of the company in Q2, Q3? And questions like, what is the company's latest expectation for EBITDA in 2020? And sometimes we also always ask them the questions like, when do you believe the company would return to historic pre-COVID operating levels? So as Matt and Dean mentioned, with all the uncertainty and volatility in the marketplace, our interactions and communication with the valuation committee or with the BDC board actually increased substantially. Naturally, they have more questions about the valuation framework, approaches, and assumptions, especially on borrowers showing signs of stress or distress. And they always want to know is how we observe in the marketplace, is what considered as best practices, what their peers are doing.
Thank you, Cindy. Any thoughts from you, Matt?
Yeah, I think from an audit perspective, certainly we are in close communication with both the board and management. I would say we're probably in a lot of ways closer than we were before, just fielding more questions. A lot of questions, as Cindy mentioned, around, are you going to be able to ensure that we get our audit done timely, and what are some of the challenges that you're facing as an audit firm. And I would say, all of this stuff has been electronic for a long time. Work papers are electronic. Those really aren't challenges that I would say that we're facing right now. I would say, to the point that Dean made earlier, just ensuring that everyone is close and working as a team and making sure that we're focused on getting the job done as a group. Those are the areas that we've been focused on. And some of the things that we're doing is just having these more like virtual experiences where you can have the team all working together, almost like you're in the same audit room, right? Or bringing folks in from management to sit with the team to help answer questions, or to go through certain technical accounting issues that come up. But I'd say for the most part, it's been pretty seamless from an audit perspective, which is good. And knock on wood, right? Because the 1231 cycles are always when you're challenged the most. But nothing to make me think that it won't go as smooth as it's been before.
Great, thanks, Matt. And that goes back to your opening statement of the BDC industry is doing well in these times with making sure they're getting everything done that they need to be doing, and with their respect to their financial reporting. And then to turn, I guess, to a slightly different topic, as Kristen noted in the intro, many BDCs are looking at liquidity. Many BDCs have either cut, reduced, or delayed dividend payments in an effort for the BDC industry and their specific companies to be looking at their liquidity options and dealing with their portfolio companies. Part of that, of course, is a company's credit facilities. And Dean, we're hoping you could give us some thoughts on what you've seen from banks that you guys have been working with, or hearing from others in the industry about credit facilities and the impact of this market on those facilities.
Yeah, that would be happy. So it's interesting. I'll just, as an overall statement, I'll compare this time to 08, 09. And I'll tell you, it's significantly better. I think you're dealing with in 08, 09, you had such a transformation, and it was a really liquidity financial issue problem that I think you saw a lot of banks really seize up much more quickly, especially for our types of illiquid assets. I think now it really has not been a bank issue, and I think the issues that you're seeing are revolving a lot around valuation and a lot around how healthy are the really underlying companies. So I think you've generally seen the bank market operate well. When you think about the dynamics for typical BDC manager, you have your BDC where it's often a mark-to-market syndicated floating rate facility with real covenants, and then you have an unsecured that basically, as long as you pay them, they're happy. And the dynamic is really within that bank group. Do you have a leader who knows the industry, is knowledgeable, and is really engaging with you through this time to lead the group? Do you have participants that don't know the industry that well? And quite frankly, how are your covenants versus mark-to-market? So I think that's been the dynamic that's really been, the interplay between those parts. I mean, if you have a number of participants who don't understand the industry, and then your Q1 valuations could be really difficult to stomach. So I think, that's been the biggest issue that you see through. And I think that the more you were able to have created relationships over time with your bank group and be able to know everyone in your bank group knows you as a manager and knows the asset class, the more likely you are to been able to, with limited disruptions. And the other type of facility that typical managers of BDCs are in their private funds and their SMAs, and they're often a single lender facility or just a couple of lenders. And a lot of those facilities are not mark to market. So they're based on the underlying performance of the portfolio company to determine a borrowing base. So I think those facilities, you have a better chance of creating a long-term relationship with a lender where you're not necessarily having to react to forces that are driving valuations beyond the performance of the company. So I think when you look at the spectrum of facilities, I think the most important thing to keep in mind is that this cycle has been much better than 08-09, and that the ability to have bank groups that understand your portfolio and understand the market, and add on to that, hopefully, an institution that supports their BDC lending group, you're in a good spot. But I mean, generally, it's been very different than 08-09, not nearly as much sort of knee-jerk reactions that have really hurt underlying companies.
Great. Thanks, Dean. And Matt, from your perspective, when it comes to your clients, BDCs generally, that may need to amend their facilities or enter into covenant waivers under their facilities, any guidance from the accounting perspective or even the SEC perspective?
Yeah, I think the major thing that they should consider focusing on is the disclosure, right? And that's where you really get kind of caught up on some of this, is ensuring that the disclosure around the financial statements are clear when it comes to some of the credit facilities. Make sure not only from a quantitative standpoint, but also from a qualitative standpoint, that you're getting the correct information into the financial statements in other places, whether it's the registration statement or the right place in the filings. Typically they're right, but sometimes we get in the process of just rolling forward the financial statements so quickly that you got to make sure that you have the newest contract, that you're looking at the right credit facilities, and making sure that everything's just disclosed properly.
Great. Thank you. And then I guess consistent with thinking about liquidity and what BDCs are doing, it seems that the capital markets generally for equity, not really there. There haven't been many equity capital raises. There's certainly been a few debt issuances lately, and I know of clients that are thinking about rights offerings and different things like that. Dean, from your perspective, do you have any thoughts on where the market is for capital raising for BDCs and focusing on, strengthening their liquidity?
Yeah, I think if you look, things are changing and shifting to our benefit, from a manager's benefit, clearly week to week. I think that, there's really not an option in any type of investor-friendly way to raise equity. So I think if people are talking about raising equity, it really has been a, massively defensive, play forced by lenders to deleverage business. I think the sector is trading at 75% of NAV, 80% of NAV, so that's really not attractive, and so it's been forced to do it. Where I think you're seeing things become more attractive is on the fixed rate debt side. So whether it's, baby bonds or regular way bonds or private placements, I think you're seeing managers are realizing that bank mark-to-market facilities with bank groups, that you relying on too much leverage for that could really leave you in a difficult spot when the market turns like it did, regardless whether your underlying portfolio is holding up. And having more capital, perhaps in fixed rate debt, and moderate the amount of floating rate bank debt could be really helpful. I think it allow a company to get to a higher total debt leverage. People are realizing, meaning you're able to have a secured lender group that is more comfortable in the size of their facility, and it'll be more flexible and allowing total leverage to go up if it's growing in the unsecured bond. So I think people are looking at that avenue as probably the most attractive. The issue is the rates, but some recent activity you've seen. You had people that during the teeth of the pandemic raised fixed rate debt at 7-8%. That is just generally doesn't work with our model. But you're seeing it come back to almost normal levels. So I think that's one of the more attractive paths for people to raise capital now. The other thing you're seeing is no one wants to, asset sales are another thing that you do because you sort of have to. But I do think there's some creative use of JVs where there's an ability to delever the balance sheet and bring more capital. But generally right now, this is not a great time to raise capital to get on the front foot and grow. If you had capital, that's great. And you're typically raising capital now to alleviate liquidity or to give sufficient liquidity going forward.
Thanks. And Matt, anything, words for the wary on accounting issues to the extent that, as Dean noticed, there's a defensive capital raise or thinking about different terms of debt issuances?
Well, one thing that came to mind as I listened to Dean talk was really around the asset coverage ratios, right? And we saw some issues around asset coverage more at the beginning of the pandemic. And there was the SEC no action letter that came out around asset coverage. And, you know, there are some what I'll call stringent hoops that you have to jump through to be able to use that no action letter. You know, we haven't seen folks really rely on that no action letter. But, you know, asset coverage seemed to be an area that was of a greater focus a couple months ago than it recently has been. But it's an area that, you know, folks should just keep in mind as things continue to move forward. And, you know, Stephanie, are you hearing of anybody who's relying on that no action letter?
No, I think like you, when it first came out, a lot of people were asking questions and trying to figure out what it all meant and whether or not it was helpful. But because of the stringent requirements, I think most have decided it wasn't worth the effort, frankly.
Yeah, and, you know, and quite frankly, even with the gyrations, it wasn't the regulatory test. It was the bank covenants that you had to worry about. So it didn't matter what the SEC said, and the restrictions on doing more investments that's really weren't, the vast majority weren't getting to that problem. The vast majority were blowing the much lower ratios that their bank groups had. That was what we sort of looked at it.
That's a good point, Dean.
So we are almost out of time here. I'm going to ask our panelists if they, have a 30-second last word thoughts about, managing BDCs in this environment, and we'll wrap up. Maybe Dean, we'll start with you.
Yeah, I would say, like, if you would have told me in March, when the world seemed to be just falling apart, that I'd be sitting here in August or September now and saying, okay, we're still not back in the office. My portfolio is really stable. We're doing deals again without ever going back to the office. We're still living in this environment. I would have sort of been shocked because I think everyone was in the mode that, the summer will come around. And so I think one of the, the things that just sticks with me always is sort of the resilience of this platform and the ability to immediately go remote and continue working through it. And, unfortunately for now, this new normal is becoming a little normal, hopefully not for much longer, but it's sort of surprising how well we've been able to do.
Yep. Cindy, to you, any last thoughts for our group? Cindy, I think you're on mute.
Yep. Sorry about that. Yeah, I agree with Dean that, hopefully we get back to the new normal very soon, and our offices have the soft opening, because I'm actually concerned about December. I just hope that would not be another unexpected market event, because December 31st is a very important evaluation date for our clients, for ourselves, and technically 60% of our annual workload all related to December. So I'm just hoping that weather goes fine, and even if people working remotely from home, they be able to connect and get the work done, because everybody want their marks on time.
Sure. And Matt, to you?
Yeah, I guess I would start off by saying, when it comes to valuation, just make sure that you're focused on exit price, as we talked about earlier. I would relook at policies and procedures that you have around personnel, around the financial reporting oversight rules as well. Also take a very close look at your expenses, because this will be certainly an area where we'll see the SEC go back to and look into. Also incentive calculations in those sort of things will be a focus area as well. But, exactly what Cindy and Dean were pointing to, for the most part, we're doing well. We're doing it better than I probably would have said that we would be if asked 6 months ago. So, I'm excited what the future holds.
Great. Well, with that, I think we're just about out of time. On behalf of myself and my colleague Kristen, we'd like to thank all of our panelists for participating and joining us today. And we hope that we've provided some information and informative views on dealing with the pandemic and operating your BDCs. So thank you, everyone.
Thank you.
Thank you.
Thanks.